Hello, and welcome to the Center for Business Modeling's Expert Series podcast. The Center for Business Modeling's mission is to help business leaders and entrepreneurs plot a simplified path to success with a full array of streamlined financial, operations, sales, and marketing planning tools. Our guest today, and by the way, I'm your host, Nate Warren, is Todd McWhirter. And in the interest of making the best of your time today, Todd is going to give you about 15 minutes of solid insights. You can get on with your day and focus on what you do best. Hey, Todd, good morning.
Good morning, Nate. Thanks for having me.
Absolutely. It's our pleasure that you've joined us. So in short, for those of us who are just joining in, this talk, if you are trying to launch a startup that's going to require investor dollars, this talk's for you. Todd's been an investor in startups for more than 18 years, and during that time he's analyzed more than 300 startups and raised more than $13 million for both his and others' ideas. This adventure has brought him both devastating failure and wild success. And Todd, as I understand it, today you're going to talk about how important that crafting a good exit strategy is when you're planning a startup.
Yeah, and in particular when you're planning on raising money.
Absolutely. So that being the case, I'm going to get out of your way and give you the podium.
Well, thank you, Nate, for the kind introduction.
You bet.
So if you're listening to this podcast, chances are you're an entrepreneur who's trying to raise some money to launch or scale your business. Or maybe you are planning on raising the money in the future. So I first want to say with all sincerity, it takes great courage to be an entrepreneur. And I commend you. Entrepreneurs like you are making this world better. You're solving problems. You're filling needs. You're creating jobs. Truly hats off to all of you entrepreneurs. So my goal really is to give you a few tips. As an investor myself, give you a few insights into the mind of the investor when it comes to the exit strategy to help you raise the money you need. Like Nate said, I've analyzed well over 300 startups and have invested in 26. Why did I say yes to the 26? More importantly, maybe, is why did I say no to over 274 ideas? Most entrepreneurs think we say no because the idea wasn't good enough. Of course your idea is important, but at least for this investor, and I suspect the majority of investors, your exit strategy is, as far as importance, trumps the idea. Let me explain. Using the analogy of a front door and a back door can help you understand the importance of your exit strategy. We investors enter your business with your offering, the front door. We make our money via the exit, the back door. If you only remember one thing from this podcast, I hope it's this. If investors don't understand and believe they will get out the back door, they will never, ever enter the front door. In other words, a big reason I said no to over 274 startup proposals was because they had a weak exit strategy. I did not believe or did not quite understand how I was going to get my money back out. I thought I might just get stuck in the house. Therefore, I said no to the opportunity. So what makes an exit strategy appealing? 3 words. Exciting. And what I mean by exciting is an extraordinary return of investment. Detailed. And thirdly, it has to be based in reality. If your exit strategy is lacking in any of these areas, raising money will most likely be a frustrating experience. Think about it. Investors know the risks are high. They know that many of their startup investments will fail. So they are naturally looking for something very exciting if the company succeeds. Certainly they care about the idea, but the idea is yours. You have detailed plans, I'm certain, on how your baby, your idea, will become great. This is obviously important. The investor's baby, however, is the cash we are investing. And we need to see as much detail surrounding that cash as we see surrounding the idea. How will our cash grow? And how and when will a multiple of that cash come back to our wallets? We're looking for detail in that area. And finally, reality has to be a part of the equation. An exciting, detailed exit strategy that is pie in the sky will not help your money-raising efforts. Let me briefly share the 4 basic exit strategies while staying focused on the need for the exit to be exciting, detailed, and based in reality. These 4 exit strategies, dividends, selling the company, buying back shares, or going public, are really the only way we investors can get our money back. That's it. If none of these exits happen, we're stuck in the house. Our money, our baby, does not experience any real growth. Even if your company is growing in revenue, with no exit, there is only paper wealth. And believe me, paper wealth that is not liquid, with no clear liquidity in the future, is not exciting for us investors. I hope it makes sense that we investors are going to be looking very closely at your exit plan. We're going to be asking ourselves, is this exit plan exciting enough for the risk? How much detail has the entrepreneur given the exit? Have they given the exit as much detailed thought as selling the product? And how realistic is this exit? So let's take each exit and let me again drive home the importance of making sure your exit is exciting, detailed, and based in reality. Have I said those 3 words enough, Nate, yet?
Yeah, I'm starting to feel like it's getting tattooed on my forehead.
They're important. So let's just take one at a time. Let's take dividends. A couple of positives on this exit. Some investors are looking for cash flow, so it directly appeals to those investors. Another positive is that a company paying dividends is clearly focused on profit. Being profitable allows for all other exit possibilities down the road. If you are a dividend-paying company, for example, your ability to attract a buyer for your business is increased greatly. So now let's bring in those 3 musts: exciting, detailed, and reality. Let's bring those into this particular dividend exit strategy. If your exit plan is dividend, then you better have financial projections that show detailed expenses and realistic revenue numbers. Quick little story. I was with an entrepreneur that it was a dividend exit, and I was looking at their pro forma, and I pointed out a few expenses that the entrepreneur had not thought about. He had sort of lumped expenses in big, broad categories. And so I brought up some detailed expense potentials. He said this is my first stab at expenses. Wow, I didn't invest. It was clear to me that he had not put enough detailed attention into his expenses and was trying to raise money with, quote unquote, his first stab at expenses. So let's take the exciting word. A dividend has to be exciting, extraordinary return on our money. Now, for example, if it takes more than 5 years for us to recoup our initial investment via dividends, if this is your exit, it's probably not exciting enough. Why? Because of the risk that we're taking, that we know many of our startups are going to fail. Okay, so let's say you have an exciting dividend goal, you have detailed expenses, and you have realistic projections. Is this enough? Well, there's one very important piece of the puzzle that investors need to see. I call it the same page philosophy. Same page philosophy is this. We investors want you entrepreneurs to get crazy wealthy, as much as you do. However, we want you to get wealthy the same way we do, as shareholders, not as employees earning huge salaries or taking huge bonuses. We want you to need and want the exit to happen as bad as we do. There are many things you can do to create the same page philosophy with us investors. But for this talk, let me just explain one. If your exit is dividends, and you own the most shares out of any shareholders, wouldn't it put you on the same page with us, wanting, almost needing dividends if you put yourself on a salary cap? Talk about bringing realism to your exit plan. It's just a great way to put you on the same page with us investors. So let's take the selling the company as your exit. This is probably the most common exit I see. This exit appeals to the largest segment of investors. Investors love to see their money grow and then get cashed out. Let me tell you another story, though, bringing in those three musts. I remember very clearly an entrepreneur telling me their exit was to sell the company in 3 to 5 years for a large multiple. Sounds great, right? So naturally, I asked questions about his plan. Who do you think might acquire you? His answer, lots of companies would love to gobble up a company like ours. I asked, who in specific? He dropped some big names. I asked, have you any research on what acquisitions have been made by these companies recently? His answer, no, we've not really started that research yet. Needless to say, I did not invest. No detail, no realism, and definitely not exciting. If this is your exit of choice, selling the company, don't forget to bring in those three musts. Make sure your pro forma has detailed expenses, revenue, and profit projections. Make sure you have researched recent comparable acquisitions. Almost every industry has examples of bigger companies buying smaller companies. Showing us investors examples will give us confidence that there's reality to your goal of selling the company. Yet, the sale price not only has to be realistic, but exciting. So, for example, if we're buying in at, say, a $1 million valuation, and the sell price projections for your company are around $5 million, you might have a problem. A 5x return, considering the normal startup risk, probably won't bring many yes investors. And finally, brag on your team and your board. Selling a company for a huge multiple is no easy task. We investors are looking at your team and asking ourselves if this team has the capability to succeed at the task of selling the company down the road. We are looking for a track record. We put more weight on the team or the ability to build a team than we do the idea. Show us you have the team that can execute, and your exit becomes much more realistic. So let's take the buying the shares back exit. I'm not going to spend much time on this exit because I don't think this exit will bring you many yeses. It works for niche investments like a real estate deal where there's no bank involved. Therefore, all the money invested has collateral of a building. There's limited risk in that scenario to the investors, and so buying shares back can work in that niche. But in the normal startup investments, it just doesn't make a lot of sense. You usually can't project a realistic buyback at a multiple that makes sense to investors considering the risk. Questions arise. Where are you going to get the money to buy us out? And then, why are you buying us out? There's a natural conflict of interest that arises. Usually companies buy shares back when they know the price is right, i.e. cheap, and they're confident the company will be worth way more in the future. So let's move on to the final exit strategy, taking the company public, or what's called an initial public offering, an IPO. The easiest way for me to cover this is to list a few pros and cons. The pros, it's extremely prestigious, and the awareness that your company gets is amazing. And there really is potentially a massive ROI. Think of the recent Twitter that went IPO. They're worth over $20 billion now. So it can be very exciting. When you're that public and that there's so much awareness around your company, you can attract top talent, partners, lots of cash is coming in, and you can use that cash for acquisitions or scaling your company. So there's lots of pros. The cons, this is not for first-time entrepreneurs. It's extremely difficult to take a company public, do an IPO. There's stock performance risks. The first investors typically have to wait, after the company goes public, we have to wait a year before we can sell our shares. Many things can happen in that year. Things can go up, down based on things out of your control. You surrender a lot of control. When you're raising millions and millions and millions of dollars through taking a company public, you surrender control. There's lots of dilution. And there's a high level of scrutiny, lots of regulations that need to be followed through this exit strategy. But let's bring in the three musts. Is this exciting? Yeah, it's pretty exciting, usually. Is it detailed? Is it based in realism? Detailed and based in realism, that's the tough part. I rarely see a detailed, realistic strategy to go public. I've had plenty of entrepreneurs tell me this is their exit. And when I ask their plan, they have said things like, once we are at X revenue, we will engage with the right investment bank who will help us do that. Pretty vague. Taking a company public is not for the first-time entrepreneur. Most investors will not be convinced of this exit strategy unless you have a proven team or a board of directors who has done this before. Even then, they will want a detailed plan showing your steps towards a successful IPO. I don't want to sound negative on this strategy, as it is very exciting, but it is the most difficult exit by far. And if you are using this as your exit, you must be prepared for investors to scrutinize your ability to succeed. So thank you for your time. I mean, I appreciate it. Good luck raising money. And I appreciate you, Nate, letting me give my 2 cents out there.
Well, and if our listeners out there are serious about succeeding, I'd imagine they'll appreciate your time as well. Hey, Todd, before we jump off, do you have time for a question or two?
Sure.
Just so we've got you on the line, can you tell me all about other kinds of what else about an exit strategy really tends to grab your attention and makes you more likely to reach for the checkbook?
Yeah, that's a great question, actually. There's definitely a few, like I would call cherry on top things you can do. A couple of them I'll cover real quick. One would be offer warrants. These are basically stock options for the first investors. The more appealing the warrants, the more likely they will help turn maybes into yeses. For example, you can offer something like, if you put $25,000 in, if you invest $25,000, then you will have an option for another $25,000 at, say, a 50% discount from a future round of money raising. There are many ways to set these up. That's just one example. And by the way, any of you, the listeners can feel free to connect with me on LinkedIn if they want more information or want to discuss any of this information.
Absolutely. We've got your contact right up there in our slide. Sorry to interrupt, but go ahead.
Oh, no, that's all right. There's another sweetener that I'd love to share that does help bring out the checkbooks, and that it's one of my favorites. It's what sometimes called the preferred return. This is where you set up the deal where their money until they get whole. For example, I'll share with you a recent investment that I actually just invested in. I won't give the name and details, but basically the investors, the money bought 50% of the deal, and the entrepreneurs took the 50%. It was a dividend play. The way they set it up is they set it up where we would actually own 75% of the deal, and our dividends would be coming at that level until we got money back. Once we got money back, we went back to the 50%. So there was an accelerated of our money coming back to our wallets, and then once we got whole, it went back to 50-50. It was a really neat sweetener that the entrepreneurs put together for us investors, and no doubt it helped the checkbooks come out for sure.
Yeah, it sounds like there are all kinds of creative ways to structure these things if you really listen to your investors and understand where their levers are.
No doubt. Understanding the mind of the investor is really key to raising money, I believe.
And one other, if you've got the time. In your experience, does a good exit strategy serve as a self-fulfilling prophecy, or to put it another way, have you noticed that having a good end in mind gets entrepreneurs more focused on creating that outcome?
Oh, absolutely. I mean, starting with the end in mind does increase focus. I've often said a goal without a plan is no more than a wish. So in this context, an exit goal without an exit plan is only an exit wish. So, having an exciting, detailed, realistic exit plan, no doubt, will make everyone more money, including the entrepreneur.
Perfect. Todd, we really appreciate you making the time for us and our listeners today.
Well, absolutely. It's been my pleasure. And again, if anyone wants to reach out on LinkedIn, feel free. And thank you, Nate, for having me.
Absolutely. Yeah, those of you who are watching along, see we've got Todd's LinkedIn link to his profile right up there on the site. So please feel free to reach out to him, unless, of course, you haven't done any work on your exit strategy. In that case, do some of that, then get a hold of him. That's it for this installment of the Center for Business Modeling's Expert Series podcast. As always, we're here to help you take the brain damage out of business planning. So feel free to head on over to centerforbusinessmodeling.com and avail yourself of the many free resources we have on the site right now. Until next time, this is your host, Nate Warren, thanking you for listening once again. We look forward to seeing you again with more great guests and their business planning insight. Good day, success to all, and keep planning to win.